Well, basically this morning I talked about the China real estate stuff, but the real big news from that perspective was the CPI came in hotter than expected. So the CPI coming in hotter than expected caused the indexes, these indexes, to fall what they call precipitously, but then they climb back precipitously, so, or anti-precipitously. Not quite sure which way that would go. Fall, whatever. Anyway, so here we are with our very, very quick reversals because, yeah, we had a lot of inflation, like way higher than expected, but who cares? But that was good. It was good timing because it was a day when Powell was talking to Congress and he acted like it was no big deal. It's a fluctuation in the data, blah, blah, blah. And so everybody's like, oh, okay. And here's the duration of the panic. It's very easy to see in the VIX, right? It's like, panic, don't panic. Nothing to worry about at all. We're right back where we started on the VIX. It's a very weird market, I got to tell you. So oil's come back down in Europe too. Gasoline came down. You know, everything's cooling off. Natural gas is still climbing because we have more cold weather. The bonds, look at the bonds though. The bonds there have a different outlook. The bonds are saying, you know what? This is inflationary. The bonds don't like the stock market. Bond traders are like, wait. It's like, you know, Powell saying don't worry about it does not override the fact that we had some very worrying data. But that's the bond market, and hardly anybody does that anymore. Well, somebody must be doing it because we're in the U.S. we're selling. How much is it? It's like 3.6 trillion. Might be bigger than that. 36 trillion in debt. I think it's like 7 trillion actually. I think it's like $7 trillion worth of bond rollovers each year. That is the right number. $600 billion a month of bonds that we are selling at auctions. That's just completely insane. And you have to put that into perspective. You have to think about, you know, let's see, we don't care. Do we care about the oil report? Well, while we're here, let's take a look. Through January 1st, that's an old report. Why is there no EIA report? Weird. PETROL, Petroleum Status Report. So I'm going again. Sometimes it doesn't refresh if you don't do it. There you go. See, February 7th, fixed. Oh, except I used the wrong one. I wanted the 1 o'clock. There it is. Oh no. Ooh. See, that's what the problem is. The full report is for the weekend in January 31st, which it shouldn't be. The 1 o'clock report isn't out yet. The short report from 10:30 over the crude oil imports, total gasoline import. Okay, don't care. Stocks increased by another increase. This is horrendous to these guys. Total gasoline decreased by 3, and distillates increased by nothing. So a slight draw this week, but still, I mean, a slight build this week, but still another build. It is kind of crazy. All right, so what were we going to look at that was more important than this? Nope, I forgot. Oh no, that was too distracting. Yes. We're going to talk about debt, right? Debt by country. There you go. That seems old, 2023. Wonder when this is. Don't you think there should be a date on it? Don't you think a date would be prominent on something like this? Oh, well. This is about right, though. The other one didn't look right. This looks right. Come on. Oh, well. Oh, I guess you can tell by the size. I don't know. It doesn't give you the damn size of the debt either. 21 trillion. Oh, this is super old. Ah, that's that is so old. 21 trillion. We crushed that. Huh? What is going on here? There we go. Tools. Time past year. Let's give it a year. $102 trillion. See, this is visualizing 69 trillion, so obviously more updated. Really doesn't matter when you look at it. It was a total disaster. Okay. Oh, there you go. 36 trillion. Yay. All right. That's us. So we have 1/3 of the world's total debt, over 1/3 of the world's total debt. The next largest debt is China, who have half the debt that we do. That's why this is so messed up. So China's debt to GDP is 90%. Ours is like 150%. So who would you rather lend money to? Now, Japan's debt to GDP, oh, it says that right here. Debt as a percentage of GDP. Japan's debt to GDP is over 200. It's at least 250 and heading towards 300% of GDP. Singapore is another disastrous country. Here's Greece. Here's Sudan. Not too many people in that club. China, I'm just seeing if there's a worse color. France, bad, right? And you're not supposed to have that kind of debt in Europe. It's really against the charter of Europe to have that kind of debt. The whole rest of the world, 2.14%. But this is, I mean, there's a couple of hundred countries, so, you know, the other countries don't have very much. But it's just like an income distribution, right? There's debt distribution. But the point I was trying to make before I got distracted and forgot what I was doing, is that when we're selling, global government debt has increased by 42 trillion since 2015, when it was $59.7 trillion. In 2015, our debt was more like what it was on that chart before. On the other chart, we're the ones sucking up all the debt. Total government debt, $102 trillion. Obviously, we have to roll over our $36 trillion worth of debt. Has to roll over every roughly 15 years, and that's I'm sorry, not every 15. You're only talking about every it's like 4 years, 5 years. So every 5 years, let's say, and that's where the 7 trillion a year comes from. Oh no, it's more complicated than that, because it's we are taking on $2 trillion worth of new debt. So we're adding $2 trillion a year of new debt 2 trillion a year of new debt. That's you know, I mean, wacko number. 2 trillion a year is like, pick any of these countries, that is all of their debt is what we add in a year. And the thing is that, and this is why we're having a conversation today about why, you know, the bonds, why the bonds are reacting differently than what you'd expect. Because the fact of the matter is that every single month, all of these people, plus US bond, you know, US bond buyers too, but all these countries have to swallow $600 billion worth of our debt. 2 out of 7 would be it's about 25. So let's say about 25%ish of the debt is new debt and 75% is rollover debt. So the thing about the debt is that this is the only thing saving us, by the way, is that when there's a rollover of debt, the bonds get cashed out. So we are paying. So you know, you borrow $100 billion from us, and when your bond matures, we pay you the $100 billion back in cash, plus, you know, interest and whatever. But you get your $100 billion back. Now, fortunately, you're the kind of person who is predisposed to buying bonds. And also, fortunately, there aren't many places to put $100 billion. You know, look at Warren Buffett. Poor Warren Buffett has been accumulating Oxy Petroleum for a couple of years now. You think it would be easy? He's only up to 28%. He's been buying and buying at every turn. And that's just, let's see what the market cap of Oxy is, $45 billion. So he's got a quarter of it. So what's half of this? 2011. So he's got 11 or 12 billion dollars worth of it. That's how long it took Warren Buffett, who's the best there is at what he does, like Wolverine. That's what took Warren Buffett 2 years of relentlessly buying Occidental in order to pick it up. And by the way, what a horrific 2 years he's been buying it in. This spike is when he announced that he had 10% of the company. Because when you hit 10%, you have to tell people you have 10%. So when he became 10% shareholder, he had to reveal that. Everybody plowed into Oxy, and then they all realized that there was no good, you know, after a few more earnings reports, they realized, oh, this is not a smart thing to be putting our money into. Warren Buffett does not realize that, and he keeps putting money into it. He might be right at this price. He's probably right, but not. He wasn't right when he started. He wasn't right during these years of accumulating it. That was a crazy price. But we'll see. You know, Trump's bringing fossil fuels back as much as he can, so should be good for Oxy. Anyway, point being, this is how much time it takes Warren Buffett from, let's say, somewhere around here, probably when they started getting cheap or cheaper, from somewhere around here until now, he has only accumulated $12 billion worth of a company he's trying to acquire. Might go a little faster now, considering it's down like 48 bucks. But the point being that it's not, where do you put $100 billion? And don't forget, we're cashing out on rollovers $400 billion a month of rollover, 4.8, 5 trillion. So $5 trillion a year of rolling over existing debt, plus $2 trillion a year brand new borrowing. This is what we're doing. So it's not about, and this is the important thing to understand, though, it's not about the rollover, because the rollovers mostly roll into the same stuff. Because why? Because you're rolling over this debt. Obviously, it's not usually one guy with $100 billion, but it is big sovereign wealth funds that do have $100 billion. But it's bondholders who have to now make a decision and say, well, where else would I put my money? I just got paid back from the US, which is why I invest in the US in the first place. It's you know, A-rated, and they've never defaulted and so on and so forth, although I think that may be coming under Trump. But the bondholders want to be safe. Bondholders are like your grandparents. I mean, they just want their interest. They just want to know they want to know the money is safe and that they're going to get their interest and that they know exactly what they're going to have at any given time. That's what a bond does for the US. Can you think of a safer country? No. I mean, logically, probably Switzerland is safer, probably Sweden is safer, Norway is probably safer. I would have argued that Canada was safer, but Canada is no longer safe because now there's this tariff war with Canada to correct the economy. Correct our economy too, but you know, let's talk about Canada. There are not many places where you want to put money. So you have a very limited choice to put a large amount of money anywhere. And then there's conversion and the safety of the currency float, of the stability. So in other words, you could have put your money in Japan, but here's what would have happened. Japan, Japan, Japan. What is this? Oh, futures. I gotta go to futures. So currency, sorry, we're gonna look at currencies. And we're gonna look at months. Okay, so if you lent money, if you're Japanese and you lent money back here in 2021, 4 years later, you went from 97 to 65, which is 32. So 32 divided by 97, you've lost 32.9%. You lost 34% on your bonds. It doesn't matter that you get your money back because you're getting it back. Oh, I'm sorry. I apologize. I'm sorry. If you buy a Japanese bond in dollars, that's what the situation is. If I buy a Japanese bond in dollars, they're going to pay me back in the yen that it's priced in. So I'm going to get back. Sure, I get back 97,000 yen, but now it's only 65,000 yen. It's only worth 65,000 yen because it's deflated. So that's terrible. And that's true of every country except, remember I said Switzerland. Switzerland, no, is good. Europe, bad. England, bad. This wipes out your interest. New Zealand, no good. Australia, no good. Canada, oh my God. I mean, Canada got creamed. So, you know, when you're investing in a bond, you're also investing in the currency of that country, and that's what makes it tricky. And so America is the clear global winner. And because of that, though, we get a lot of customers to buy our bond debt. And that makes it harder for other countries to sell their debt because people are taking their money and saying, no, I'm not buying your money. I spent my money on American bonds. So that's the dynamic that we have right now. If the dollar starts to weaken, then that dynamic will weaken, and then what's the repercussion of that? The repercussion is that if our currency and our bonds become less desirable, then the variable is how much rates are we going to offer for someone to buy our bonds. If you feel America is less secure, if you feel it's less stable, if you feel that Donald Trump, who just said they may not have to pay back all this debt. He actually said that. What did Trump say? Trump bond debt. Yeah. So nobody knows exactly what he's talking about so far. But what he's saying, and this does not accomplish his goal of lowering bond rates, by the way. Oh, come on, Reuters, you stupid bastard. Speaking on Air Force One, Trump said officials are reviewing wasteful spending, suggesting the country's $36 trillion debt load might not be that high. By the way, here's a problem with everything. Problem with everything, frankly, is the 10 or 12 reporters who are on Air Force One with the president are not necessarily economically savvy reporters. They are probably, although they're not, because now Fox, now it's like Fox and Breitbart and whatever, it's like it's Trump's handpicked fellows. He doesn't invite, he has to invite a couple of like real sources of news, but he basically has just like started inviting randos on Air Force One. But the point being that of the crew on Air Force One, that's why you get these vague things and there's no follow-up, and he wants it that way. But in other words, he says something that's earth-shaking, that debt payments may not have to be repaid. But there doesn't have to be any basis to what he says. He's just saying, hey, some of these bonds are, we're in poor faith. They weren't bought in good faith, and we're not going to pay them back, or we're going to renegotiate our bonds. What is that? That's what's called a default. When you start renegotiating your bonds, you're defaulting on your original agreement. If the U.S. becomes a less reliable bond seller, then the prices demanded are going to go up considerably. People are going to be a lot more worried about the risk of default. They're going to have to buy insurance against the U.S. defaulting. You probably have to buy it now. If you're a big buyer, if you're a big commercial buyer of bonds, you have to buy insurance against default. The insurance company is going to reweight the risk of the U.S. defaulting, and that will then damage the bond return. The amount you pay for the insurance is the amount you don't get back as a percentage of interest. So like a whole separate thing where, it's like if you have a bond that pays 5% a year, the insurance on that bond may be 0.5% a year. So you end up netting 4.5%, but you got the insurance in case they default. The US has a very low chance of defaulting. When Greece was in trouble and their bonds were 20%, the insurers were asking 5% to insure it. Because there was a very high chance of default. Sometimes the insurers walk away completely and say, we don't trust this crap. So anyway, point being that the reporters on Air Force One don't ask the obvious follow-up questions. They don't understand the bond market well enough to say, Mr. President, what do you mean? What bonds are you talking about? What the fuck? At some point, this is like an earth-shaking concept that he's saying that there are some U.S. bonds that we may not repay. What the hell is that? So people on Monday were left speculating, indicated possible reduction of the country's overall debt going forward, resulting from an overhaul, blah, blah, blah. Said unlikely to mean disruptions in the upcoming debt payments. It could be Treasury payments, which is not directly linked to Treasury bonds. They just have to sit there and speculate as to what he said. It's like, well, he said something, but nobody asked a proper follow-up. They just submit like this thing. It's like, oh, here's one of the things the president said. We may default on our bonds. So anyway, oh, wait. Nope, see, nobody knows. This is nobody. You're not getting anything other than the speculation here from people. We view Trump's comments as referencing specific payments because everyone's got to calm the market down now. That's not good. And that's how you get all this fun action in the bond market. Oop, that's long term. Days. So that's what started us going down. And now today with the inflation, it's a real kick in the ass. And we've moved down sharply, and the bond market is not recovering because these are clear signs of inflation and that things are not going as well as they think. Oh. Now, somebody's saying how to adjust a Crocs position, Cody. Oh boy. That's a lot of stuff, Cody. You really got to ask during chat because that's I don't know if I have time to do this whole thing. Let's see. He has a Crocs position. He's got some Crocs. He's got a put, an open trade detail. See, I'm not sure what you're doing here. You like pasted in some crap that doesn't read very easy. Basically, oh, that's better. Basically, I own a January 2027 short put and 2027 100 150 spread. Here, see, here's one problem. When you have a 150, this is important for everybody. When you have a 100 150 spread on Crocs, does it say when you bought it? 11/15. So he bought it in November, and he bought a 100 150 spread. So he paid a lot of premium for his 100s. I'm not going to get into the exact numbers now, but he paid a lot of money for his 100s. Then he sells the 150s. The 150s are so out of the money that they don't carry a lot of premium. He's not offsetting his premium, and there's a thing called a delta. I don't know if it's going to show up on Yahoo. I don't have my other options thing is not working. Let's see, CROX. What the hell? Boy, I'm having a lot of trouble with my stuff today. Options, Crocs. Okay. So if you're in 2027, do we have the delta? Oh, it doesn't show the delta, you stupid bastards. Yeah, I keep getting locked out of on this machine, I keep getting locked out of my Thinkorswim account because it's running on the other machine. It doesn't recognize it as like being on the same network. And it doesn't let you do that. So I don't have that. Anyway, there's a delta. The delta is the amount that's one option is going to change versus another. And the thing is that when you have the 100, and going by today's price, it's changed. You have the 100 calls at $20. You've got what's Crocs at now? 90. Okay. So, I mean, he had it when it was $10 difference. It's not that big of a deal. But you have the 100 calls at $20 or 20. You see how stupid this is? It's terribly designed. So last price. Okay. So the first column is last price. So you have the 100 calls at $21.20. And then he sold the 150 calls. Oh, I'm sorry, at $21.20. It's all premium at 100. So at $21.20, these are $10 out of the money, and they are 100% premium, $20 a premium. Then you sell the 150 calls. They are $50 or $60 out of the money now, and they have $10 of premium. So you're only covering your $20 of premium with $10 of premium. That's leaving you paying $10 worth of premium. So, and the upside is all fantasy. Crocs has to go up 50% to hit your goal of $150. That's a low probability bet. You're betting a long shot. You're going to lose when you bet long shots. Why not make a more sensible bet? Now, not the, again, it's dropped $10, but if I was going to go into Crocs, I'm going to look at the premium of each strike along the line and say, hey, okay, so, and you have to be careful because they haven't traded, so they don't change. You got to look at the middle of what the bid ask is. So the 90s at 25. How much are the 80s? The 80s are 29. So it only cost me $4 to buy the 80s versus the 90s, to buy $10 lower. So don't I want to do that? Wouldn't I rather be $10 lower? And if I go down another $10 to the 70s, now I'm going from, let's say, 29 to 35, 39. So let's add 2, let's say 37. So from here, I'm going from 29 to 37. I am not going to pay $8. Oh, I'm sorry. Wait a minute. Sorry, the 70s are there. So I'm sorry. It's 29 here to 30. Let's say 34.50, something like that. 34.70. So here it's like, so here I'm paying 29 to 34.70. I'm paying $5.70. So for sure, I want to pay $4 more to be $10 lower in strike. I don't want to pay another $6 or $5 something to be $10 lower. But 4 is a bargain. Why wouldn't I take it? So that would lock in my selection of taking the 80s here. Another nice thing about the 80s is for $29. They are $9 in the money. So I got 20. So I have $20. I'm still paying $20 a premium, but at a way more realistic price than if I bought the 100s with $20 worth of premium, right? And I'm not really spending $9 more because I'm selling these 29s, and I'm going to take a more realistic spread of, let's say, the 80s to the 100s are 21 bucks, and the 110s, now it's the reverse, right? So the 110s are $17.50. So it's like $3.50. No, yeah, $3.50. So it's like $3.50 less to sell the 110. So I'm like, oh, I guess for $3.50 less, I can have $10 more headroom, right? Now, what are the 120s? The 120s are $17.50 to let's say 15. So that's only $2.50 less. That's actually still pretty freaking good. But then I have to go, okay, before I get too carried away, is 120 a realistic target? So I'm going to look at Crocs on a nice long-term thing, and I'm going to say, geez, that's a pretty erratic stock, number one, but trading at 7 times earnings, and we had this discussion in chat recently where I said, this is not a failure of the Crocs brand. This is a failure of the management who purchased a company called Hey Dude. It did not at all integrate with their existing line. I don't even know what the hell they ever thought was going to be good about it. And it went worse than I thought. I thought it was going to go badly. It went much worse than I thought. I mean, they're better off like cutting it loose and just taking the loss. It's like an anchor around their neck, this stupid thing. And it's a distraction and so on and so forth. I mean, it's just, I don't know what they were doing. I mean, it's going to get written up as like a bad corporate decision of all time. But the thing is, Crocs themselves, when you strip away the Hey Dude garbage, Crocs itself is doing well. It's still a very solid, money-making brand of shoe. So eventually, it will resolve itself. Even if they have to fire the management, even if they have to turn over the company, even if they have to spin out the Hey Dude brand separately and take a loss, whatever they do, who cares? But the point is that this is still the same Crocs company that legitimately went up here. They're currently trading at 7 times earnings. See what else we can find out about them. So you can see they had a good year in 2021. Not well, it's COVID, but whatever. But they had a good year. Then they had a bad year. Then they had a good year. Then then they have what's still a okay year, but they're losing the money on the Hey Dude crap. It's not the Crocs brand. That's what's keeping them from falling apart completely. But what else did they do? Look at the debt. That's what it cost them. They spent 1.5 billion or somewhere in that neighborhood on these stupid freaking acquisition. A company that was making 700 million a year spent 2 years worth of earnings on acquiring a shoe brand, and they failed to execute. And so what are they doing now? They're still trying to execute, and it's killing them. It's like draining cash. So, but they're not in trouble. The company makes money. They have debt from the acquisition that they never should have, but at least they are paying that debt down. At an okay clip. They're paying the debt down. It'll take them a couple more years to work out the debt and whatever, but then they'll be back to normal. So you ride it out. Anyway, but the point being that even with this, they're still going to have worse sales and worse sales. So the next couple of years are going to have barely any top line growth. So you're not going to pay a lot of money for a company that goes from 396 to 407 and then goes to 416. That is not exciting growth at all. So you're looking at a retail brand, declining earnings, declining revenues, large debt load that they took on, and the company itself you're buying for $5 billion. Oh, you can't see this box, I don't think. So you're buying the company for $5 billion. It makes 700 million a year just on that fact alone. It's like, why not buy that? But you're also taking on this debt, so you're gonna have to factor in the time to pay it back and so on and so forth, and the overall environment and what's going to go on. And tariffs and things like that. You don't know what's going to happen. So it's not. I wouldn't bet on it to go high, which means there's no reason I would want to take anything more than the 110s. A $30 spread is fine, and the thing is I'm protected. That's the key, because when you look over where were we? Oh yeah. So in other words, if I sell if I buy the $80 calls for 29 bucks, and I sell the 110 calls for 18 bucks, then it's a $10 spread, but it's a $10 spread that's $10 in the money. That's the difference between what you did. You took a 100, 150 spread, nothing was in the money, and it still cost you 10 bucks. That's a huge difference. And that's why you're freaking out just because the stock went down 10%. Do you think a stock's not going to go down 10%? Stocks go up and down 10, 20% all the time. And so if you're buying a stock for 2 years, there is a virtual guarantee that if you have a stop at 10%, at minus 10%, it will trigger. You are gonna get forced out of everything you ever buy if your cutoff line is 10%. That makes no sense. You have to be prepared and have a plan for what you're going to do when a stock drops 20%. And if that plan is taking the loss, don't even start. And that's why we scale in and go to the strategy section at PhilStockWorld for more on this. Members only. Where is it? Strategy. Oh, there you go. La-di-da. And I'm redoing the education section slowly but surely. So yeah, here's me talking about strategy. Here's this very important article on scaling in. I have to really make that more of a featured Like, you must read this. And how do we enter a position? I do not generally enter a position when momentum is taken the wrong way. I rarely take a full position right away. Everybody knows this, right? In fact, we are actually unhappy when we enter a position and it goes straight up because we don't have a chance to buy more. Not almost always with few exceptions, intend to buy more. But if the stock is flat, we'll buy more after a while because we get comfortable with where we are. If a stock is down, we will usually buy more. We're in fact thrilled that it went down and we get to buy more. And if the stock goes up, we're like, oh, well, I'm not going to pay more. I picked my price and now it's too high. So I'm not going to buy anymore. That's a discipline. So we make our money, which our money, by the way, when we initially go into these positions, we're aiming to make 200-300%. So we're gonna get our returns, and that's very nice. That's why our portfolios have such spectacular returns in an up market. But we would rather double down, and instead of making 200%, we make 120%, because that's 240%. Make more money when it goes against us, and we get a chance to double down. But we don't double down at 10%. We double down at 20%. Those are generally our decision points. Our 20% move up or down is where we're going to make a decision, not 10%. Otherwise we'd be constantly changing the positions. So it's all spelled out here very, very nicely, actually. Is how we get in and out of positions, how we scale into positions, so on and so forth. Where was that? Visual capital. Oh, it was Yahoo. Right. So this is a factor that people seem to forget a lot, is you don't want to, and what's our whole mantra at PhilStockWorld, right? It's be the house, not the gambler. And what that means is you should always be selling premium, not buying it. You want to avoid paying premium. And that means you put your big boy pants on, and if you want to buy a stock that's $90, you buy it at a lower strike than $90, not out of the money. The only time I would buy an out of the money like this is if it had a really beneficial spread, like let's say it was a 100-130 spread, and that's the 130s are paying 12.50 or 12 something. So let's say I can get 12. Well, he got 12.50. So let's say it's 12.50 here, and the 100s are, well, if they were 21, so 21 and 12.50 is, I think, 8.50 or 9.50. 21 plus 9 is 30. I'm confused. Oh, my brain. 21 minus 12.5 is 8.50. Okay, good. So I'm paying 8.50 for a $30 spread. That's not bad. But I'd still have to be pretty damn sure that Crocs was going straight up, and there was no reason to think it wouldn't. And if you look at Crocs, you went in November, right? So you're buying Crocs in November, and yeah, it looked like a good dip, and it did. It went up for a bit, and then it started going down. But it's still basically where you bought it. And now it took a dive, and you're all upset, but it's only a 10% drop. And they haven't even had their earnings yet. Your earnings are tonight, I think, right? Today the 13th? No, tomorrow. So earnings are tomorrow. So, are the losses going to widen? Are they going to be spiraling out of control? Is their whole business plan out the window? I don't think so. Okay, because you have to understand why they're going down in the first place. They spent $1.5 billion or $1.23 billion was what it really was on this shoe company that did nothing, didn't add one penny to the bottom line since whenever the hell it was. That's not even the dip that was from that. Nope, not there either. This one. So around here is when they did it, and people were like, what the frick, are you guys crazy? And this is when we jumped in down here, because we were like, well, they're not that crazy. But we also I think got out. I'm not even sure we still have Crocs. Oh, we do. I think we have in the butterfly portfolio or something. Either that or it's in the LTP with a lot of sales. But we're using it as a money producing play, not so much as we expect it to go flying higher. But you got to be realistic and conservatively realistic. And you never ever buy something and say it's going to go up 50%. That's just unrealistic. That's not what a normal stock does. That's not even what a normal tech stock does. And tech stocks aren't acting normal. And this is not a tech stock. It's, you can't say that you're smarter than every single person who bought Crocs for the last 2 years. That you're the guy, you came in November and you said, oh no, you guys are idiots. When it's 104, whatever the heck it is at the time, it's 104, and you guys who have been selling it from 150 down were all wrong, and now it's going to go back to 150. No. These people took losses to get out of their positions. All the people selling down here are almost certainly at losses unless they came in when we came in a long time ago on Crocs. Or whenever they came in. But if they're still there, they wrote out this, they wrote out that, they're down here. Those are the ones that are still in because they don't care. They're just waiting for it to go higher again. But anything recent, and when you look at the 50-day moving average, that's going to be recent. And the 50-day is this. Well, let's see, orange. See, this orange is a 50-day moving average, and this yellow that's barely visible is the 200-day moving average, and the 200-day moving average matters, obviously. So the 200-day moving average has been improving. But the thing is, when you look at the 200-day moving average and you see this happening, then you say, oh, you know what's going to happen? If it stays below the 200-day moving average, then the 200-day moving average is going to start coming down. But you're not going to see it for like 50 days. That's what a death cross is. The 50-day moving average starts coming down much faster than the 200-day moving average. And because of that, it's going to cross below that 50-day indicator. And look at the 20-day moving average is flying down. So why it's called a death cross is because when the 50-day is down that much and that it crosses below the 200, then there has been a significant shift in people's expectations of the stock. So you don't see it here, but then all of a sudden here is when the 20-day comes ripping down and the 50-day stutters and starts flattening out, and now it's starting to decline because we are for 3 months, almost 3 months. So for 90 days, we are consistently below the 200-day moving average, and it's pulling the 50-day moving average lower. That's how you read a chart. Everything else is bullshit. All these things people are pattern this, pattern that. It's all a load of garbage. What matters is the fact. This is a mathematical fact. This is what's actually happening. This is telling you that for the last 50 days, the average price people paid for this stock is $125. And for 200 days, the average is 109. Now, apparently, these guys are a lot closer to reality than these guys are because we're below 109. So I guess these guys were right not to pay so much. So for 200 days before this, when you came in in November, you bought it at the price that people had been paying. That's the price everybody thought it was worth for the last 200 days. For a year of trading, that's the price people thought Crocs was worth. You decided it was worth this much. But meanwhile, at that time, the 20-day was already collapsing. Recent information had caused the 20-day to start collapsing very, very hard and very, very quickly. And then the 50-day is starting to follow it because that information sticks. That information obviously was more correct. And so what happens? The 20-day comes down, then the 50 days come down, and once the 50 days come down and start crossing below the 200-day, the 200-day is going to start coming down, And then you're going to look at the inverse of this. Then you're looking at something more like this thing back here, or we can go to monthly. Well, this is by the 200. Actually, they're doing pretty good on the monthlies. It's still going up. Just trying to find a period where you'd see it, obviously. Oh, I'm sorry. These were week moving averages. This is 20 weeks, 20 and 50 weeks. Then you have to pay attention what period you're in. Here's the dailies. So in November, where is the? Oh, here you go. So in November, the 200-day is the soft yellow, which is this thing. So it was 130. But you got to look. That's why you also have to pull back and look at the monthlies and the weeklies and things like that, and make sure that you're in line with what people are expecting. And yeah, I recognize that this is, this is 7 is very low. It's a low P. It should be around 10, 12, something like that. But not if they're in the middle of a decline, because until they sort that out, nobody's going to have confidence. And you can see how rapidly this, are we in the dailies? Damn it. Starting at the last earnings report with their outlook and guidance, the 50-day moving average was taking a really nasty downturn. So from the beginning from earnings, 137, right? So from earnings until, whenever you bought it, like in the middle of November, went 120 something. All right, so it went down 15 bucks. So the 50-day moving average drops 10% in that month. Something's wrong. Sentiment has shifted. Give your fellow investors the benefit of the doubt that some of them, and yeah, obviously most traders are just, sheep and just follow the herd and whatever, but there are wolves and the wolves will tend to steer the pack, or at least the sheepdogs. And you have to give somebody in this crowd the benefit of the doubt. And of course, it's, most of it is institutional buying and so on and so forth. And you have to just say, okay, there's some validity to this. When everyone is doing something, it's like a river. The river flows a certain way. And sometimes it'll go fast and sometimes it'll go slow. But if you put a leaf in a river, it's going to follow the path of the river. It's not going to go do its own thing. Very rarely something will happen that will cause it to go one way or the other, so, one side of the bank to the other side of the bank or whatever. But generally, it's just going to flow along somewhere in the middle of the range. You can't always predict where, but it's going to stay kind of in a range. And the banks of the river are generally going to be the outside of where it's going to be. But there could be a storm and it could go way up high or way down low. And that would be what you call a channel. So here we have a downtrending channel that's basically being obeyed, right? If you drew a stick like here, going down this way, that's a downtrending channel. And that downtrending channel is the 50-day moving average. From all the way back here, last year until here, you have a downtrending channel. That's a bank. That's going to define where your leaf goes. It's going to go up and down, but it's generally going to follow the channel. Right? And then you've got the 200, and the 200 is the highest it's likely to go, and that's 130. There is no justification at all for saying it's going to go to 150. And no, you can't say because it was up here at one time, because you know what? When it was at 150, the same 200-day moving average was saying you guys are nuts. 200-day moving average crested at 130 and then came down, and that means your river is here, not here. And that's simplifying it, but it works. It's like when you do a valuation, you still want to get a confirmation that your valuation is probably right. And so you take a look at the channels that the thing's in and say, well, look, downtrend. You can see it's even drawn on this chart. Here's your downtrending channel. That's your bottom bank of the river, and this is the top bank of your river. And so your stock is going to stay in between. And as it turns out, you're drifting more towards the bottom. So it's probably gonna have a very, very hard time getting back up to the top there. Doesn't mean it won't ever get there, but you know, you just can't keep running. You can't keep betting on something that's not likely to happen. Anyway, all right. So in chat, we can talk about more of that because we're not getting anywhere. And it's already an hour. Holy crap. Wow. So let's before my voice goes, let's talk about yeah, this is full of good stocks. Here's our how to become a millionaire by investing $700 a month. Guys, this is so easy. We've done 30 of these for 30 months. And all you have to do is put in $700 a month. And we pick these nice small little positions, very diversified, very conservative. We still took a hit of like 5,000 on one of them. Otherwise this thing would be a spectacular portfolio. But we took a big hit on one of them. And but generally we haven't taken much losses or anything like that. We're up, I forget, 80 something percent, 88.3% in 30 months, 2.9% per month on the average. And at this pace, we will be, now every year we add 700 a month, which is 8,400 a year. So starting where we are now, $39,000 at 8,400 plus a month. If we keep up this rate of return, which we won't because the market's going to take a downturn soon, then we'll have $1.2 million in 9 years. That's pretty freaking good. It's going to be tricky with this portfolio to do well in a down market because we can't really we can't take advantage of a lot of option stuff. Wow, hang on. We can't take a lot of advanced option stuff because it's basically a IRA type account. You can't play with margins. But anyway, the more important thing though is the learning strategy of the thing. Oh, and again, where is the 200? Is this weekly? Is this daily, weekly, daily? Daily, yeah. So the 200-day moving average for the S&P is 5,600. So the 200-day moving average says we're 10% over, and that is correct because we're trading at just about 30 times back, not forward earnings, 30 times backward earnings. Because forward earnings are always dicey, and if you didn't learn that in 2008, you're never going to learn it. Okay, in 2008, everything was projected to be up 20%, 30% the next year, blah, blah, blah. Everybody was going to do better. Houses that were $1 million now were going to be $1.5 million next year and $2 million a year after that. That was what the whole thing was based on, just insanity. And what was the problem? Oh, same problem you have with debt. The problem is people don't have $2 million to buy a 4-bedroom home. That's too much money. I know these days you think, oh, that's not really that much. But back then it was a lot of money. You know, 15 years or 20 years of inflation later, it's you know, say 2 million for a home, they're like, oh, I'll take a look. So anyway, point being though, that the wisdom of all the investors of the S&P over the past year says that the S&P is running 10% too high. And if we keep it, and obviously if your growth, if we're going to gain 15% next year, then you could say, oh, I don't mind paying more than that, whatever. But when that starts compressing and you're no longer looking at 10% a year growth or 15% a year growth, and you start looking at 5% growth, 7% growth, maybe negative growth comes along, all of a sudden you say these people are insane. The people of the last 50 days, the 50-day moving average, these people are nuts. They're throwing money into a declining market. That's how you get across. That's how the index is smarter, or the index is showing you reality faster than the enthusiastic investors can catch on. They start selling off, and meanwhile the momentum of the bulk buyers is still going to go up for a while. But once that 50-day comes crashing in, that's when you get the death cross, and that's when suddenly all the people in the 200-day wake up and go, holy shit, who are these people? It's like a crowd rushing out of the store, you know, and you're like, maybe there's a fire or something like that. But some people would go in and say, hey, maybe there's maybe I'll find some bargains inside. You know, go against this voice. People want to go against the crowd. But when you're standing here and all of a sudden 25%, because this is 200 and that's a 50, so all of a sudden 25% worth of the people that are here go, and they're running out the door, you probably should take that seriously as a warning that you should be maybe changing your mind too. But this is a very large, very hard to steer train, and it's going to take a while for the momentum to change on the 200. You got to watch for it here. And when you're watching for it, and we talk about this sometimes, when you have to understand how this is made. So when there are a few candles below, like here, few candles below, it's not going to do a lot of damage, but it depends on how many candles and how far below they are. So if this, even if it had flatlined here, it becomes a trend that starts pulling the average lower. So this had the potential to start going lower here, but we instead went up as Trump was sworn in. It was only here, January 20th. Boom. Wait, that line. So here's Trump being sworn in at 6,000 on the S&P, and now we're at 6,066. And that was a big improvement. That was a huge jump. Went from 5,800 to 6,000 in days, and we hit 6,100, up 300 points. And that's really the entirety of the rally is what happened here. After that, drift, uncertainty. And like I pointed out, by the way, you can see it here. It's a Monday, Friday, Monday, Friday, Monday, Friday. There's a lot of that going on too. And that's not good. And you see these great big red candles, that's not good either. Big red volume lines, that's not good either. Because it means that there is a lot of selling, but when the selling stops, the market drifts back up because of people coming in, and people coming in are called the dumb money, and the dumb money is because there's a constant drip of money that goes into everybody's 401k and IRA and things like that. All the people who work, who get paychecks, and we're at full employment basically, there is a huge amount of money every single week that goes into the market. It is distributed pretty evenly among all the market participants, right? Because in the IRAs and the 401ks, you're not picking individual stocks, you're just in the index funds. You've got S&P, NASDAQ, Russell, whatever. Those are your choices when you sign up for these index funds, for these IRAs and 401ks for the most part. So it's the institutional dumb money buying that's just basically it's not discerning, it's not looking at individual stocks, it's just putting money into the market. And when does that happen? It happens at the end of the week. And then Monday, all the people who want to sell jump on the selling bandwagon with a great big red stick, and they get out. They're like, yay, they took the market up, now I can sell. Yay, they took the market up, now I can sell. But after a while, that falls apart, and you get less and less buyers, and not from the workers, but then the marginal money, the hedge fund money, and people like that, they start pulling out. Once they start pulling out, the problem is once you overwhelm the 401k buyers and the IRA buyers, once you overwhelm that crowd of dumb money that's always coming into the market, then you are like a river that is going to overflow the banks, and it can no longer contain the selling. because there aren't real sellers there. There aren't people who are analyzing the market saying, I want to buy more. They're just people who are working and putting their money into the market every week. Like my daughter called me. She just, she's got her first job this year. And they asked her, where do you want to put your money? And they had very limited, crappy choices. And I said, just do an an S&P dividend index fund. Just for now. I said, you better. I said because at her stage, she's not going to lose much. So she's putting like 10% of her income into an IRA. She's getting a match from her employer, and so she's just dripping into the stock. So I said to her, I said, you're going to take a hit. I said, here's what's going to happen. You're going to put money in this year. You're going to put in $10,000 or whatever it ends up being, and you're going to probably lose money. You're probably going to have 8,000. But I said, over the course of your life, that doesn't matter. Because you'll keep buying while the stocks get lower, and then eventually they'll come back, and you'll be making money, and you'll be happy that you have it. That's dollar cost averaging into the portfolio. I said you're better off doing that than not investing or sitting there and trying to be smart and time it. And thank God I said that, because the market's gone crazy. We had this conversation back in the fall, and the market's gone up considerably since then. So very good that she put her money in like that. But it'll probably go all the way back down. But at least but the point is, she's accumulating over the next 40 years. It doesn't matter what happens the first few years. And she's not ready to start like picking things, bit by bit by bit. This is a good way for her to start saving. So, you have to understand how these, what moves these lines? How do they change? What causes them to go up and down? That's what's important, because when we do these discussions with stocks and the indexes, whenever we talk about where they're going to be, and that's why when I say 6,000 is so critical, because 6,000 is the 50-day moving average. And if we fall below 6,000, we start pulling the 50-day moving average below this red line, and that will make this red line very, very hard to cross if the 50-day starts failing, especially if it's going to say, oh, rejected right at 6,000. That's going to look very ugly. And then people start losing faith, and then we're going to come down for a test of 56. Well, by the time it tests, it'll be 57 or something like that. But we come down for a test, which is only 5% pullback, by the way. There's only 5%. So we're going to have a 5% pullback. We'll hit 5,700. The 200 will be rising. We will absolutely get a bounce. When is that going to happen? Probably. You want to look back and see how long it took to get there. So it took November, 3 months. Wait, 1, 2, 3. Yeah, 3 months. So it took 3 months to go from 57 to 6. It's going to take 2 to 3 months to come back down. So if you want to say, when is this going to happen? And let's pull this webinar. Let's remember that, on May 12th. Okay, so on May 12th, we are very likely to be somewhere in the vicinity of 5,700, somewhere between April 12th and May 12th. And we'll be back down around 57. And again, assuming nothing catastrophic happens one way or the other. And then we'll be testing the 200-day moving average. We will get a bounce. And how much will that bounce be? I can tell you that. It's going to be the bounce of 300 points is going to be 60 points, 20%. And so that means that 57.60 will be the weak bounce, and 58.20 will be the strong bounce. So in the April-May timeframe, those are going to be the lines we're going to have to watch. Are we going to hold 58.20? Are we going to hold 57.60? And then we'll see. And then we'll see if we can break back up. Then we'll see if it was a small dip and it's going to recover, or if it's going to be, or once you go below this, then you're going to start pulling the 200-day down to follow. And plus, you're going to get that depth cross. So if we hit May 12th at 5,700 or lower, we'll be making a we'll be starting to make a death cross with the 50-day moving average on the S&P. And that will be a terrible, terrible sign for the market that momentum is shifted to the downside. Then we're going to have to start looking way lower. But for now, I would be hopeful about it, and I would hope that what's going to happen is that we're going to dip down sometime around May. We may take a spike down, but if we take a spike down, we'll hit the 200-day moving average. We'll bounce. We'll get back over the 50 and start pulling it up before it has a chance to cross. And that would be a bullish consolidation that'll take us forward to the end of the year. But until I see that on the next earnings, and it all coincides with the next time we see earnings. So next time we see earnings, we're going to have a test of the resiliency of the market to see how far we actually go. And what are my expectations? The tariffs are going to be in place by then, and we're going to see the effect of the tariffs, that we'll have more of a handle on inflation and whether it's getting worse or whether this is just kind of a blip up. And of course, corporate profits, we'll see how they do with all this sort of cross currents that are going on right now. So for now, I'm cautiously optimistic. For now, I think we have a better than 50-50 chance of holding it and going higher, even with all the nonsense. That's why we still have stock. That's why we still have stuff. So anyway, getting back to what's the stuff that we're betting on. So Northern Dynasty. Why did we buy Northern Dynasty? It's one of our more recent ones. We bought Northern Dynasty because Trump is deregulating stuff, and Northern Dynasty has mineral rights to a massive mine in Alaska. but the mine is very close to like the main salmon fisheries. And the runoff from the mine has the potential of wiping out the salmon population, which would cost the Alaskan fisheries billions of dollars. This mine is worth much more than billions of dollars, but at the moment, since they can't mine it, they don't have the legal muscle to do it, and the EPA has been on their ass. And so for 10 years, this project's been on hold. And it doesn't matter what they submit, the EPA has kept saying no, 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 no. Trump is essentially eliminating the EPA, so there's no one to say no. And obviously going to the courts doesn't help because you got the conservative courts. So short salmon, long NAK. That's basically where we are. Ford. Now, the problem with Ford is that the CEO of Ford just said, all these Trump tariffs are going to kill us. It's going to be awful. Don't say that. They just had nice earnings. Oh, I can't click on that. They just had nice earnings. They're worried about the tariffs, and they keep saying that, and that's hurting the stock. There's nothing wrong with the stock. And if there are tariffs, everyone gets hurt, and car prices will go up. She's being a bit alarmist because the reality is that the prices will get passed on to the consumer. The reality is what the Democrats kept saying would happen is that these tariffs will be passed on to the consumer because everybody will be tariffed. Everybody will be affected by it. It's not just Ford. And so the consumers will get screwed. That's all. But problem solved for Ford, they're probably going to make good money. And here's the difference. GM has not said anything. They haven't complained, and they're up 2% today. It's like keeping their mouth shut. There's no difference. Trust me, there is no difference between Ford and GM. There's no functional difference between these two companies. They are almost entirely interchangeable, and both are worth investing in. Oh, it's Ford. Now I can do it. See, they beat by 14%. They beat by 28% on GAAP. Revenues were up 2%. I mean, they're firing on all cylinders, but they're complaining about the tariffs, and they're getting hit for that. That's a dumb reason for people not to buy it. So I'm very confident in our Ford bet. And our forward bet is very simple. We have the December 8, 1182 calls. We are at 924. We're not really halfway there, but we're at least in the money. And the net of the spread is math. 25, so $1.25. So it's so it's $1.25 on the $4 spread. That's pretty freaking good. So if we do get to 1182, it's $1.25 on the $4 spread. We make a lot of freaking money on this spread. And that's current. We started off this actually we're losing money. So we start off about the same thing. It's like more like $1.50 when we started. So now it's $1.25 for the spread. But here's the point. We're $1.25 in the money. You're paying zero premium. Goes back to what we were talking about before, right? If you pay $1.25 for a spread that's $1.25 in the money, you've paid zero premium on your calls. So doesn't matter what you sold them for, you didn't pay any premium. You bought forward for $8. That's where you are. Oh, I'm sorry, you really bought forward for you bought forward for $9.25. You paid the $1.25. So if it goes up at all, you're going to make money. That's a lot better than needing it to go up $10 to break even, right? Well, or in 10% to break even. So that's a good one. HPE, stupidly cheap down here. See, there's subtle hints in my analysis, in my summaries, where I'm like, if I say stupidly cheap down here and we're already over our goal, but the spread is only net 3,300 on a $5,000 spread. We have 51.5% upside potential for the year. So between now and January of next year, this spread, John, I'm not going to do this for everyone, I'll get dizzy. If HPE simply holds $20, and when we bought it, it was only $1.60. So it was $1.60. Now it's like $3.30. So this spread, our original spread is up 100% already. Still has 50% more than our double to go. So this is fantastic. We started at a great price. We did a great spread. It's the same thing. It's the same concept. These are just basic bull call spreads. You buy the call, you sell the call above the call, and what does that do? That sells your premium. You're negating the premium that you're paying for the option by selling it to somebody else who has a higher strike. You make the money in between the two strikes. Very simple. And it costs you no margin. There's no margin to plays like this, even in an IRA. So HPE is already in the money. So this trade, as long as they don't drop 5% over the course of the year, and they finish over $20, this spread will make 50% more than it is right now. That's good for a new trade. I mean, it's, most people are really super happy with that. I know this already made 100% for us. So, we only bought it in June. So in 6 months, we made 100%, 7 months. So, and we'll end up making 300%, which is our full goal on the spread. No, 200%, sorry. Anyway, so we'll make 200% overall. But, even now as a new trade, that's a good trade, right? It only have to stay where it is. We took a lot more of a risk when we started than it is now. Because we started in June. Oh, here's June. So we started in June. Oh, well, no, not really. You know what the trick is? We took a conservative trade. So in June, now I need to know what day it was. Damn it. It's never simple. All right, so on June 4th, so early June, they had this earnings report, and we said, ooh, that was good. So we bought it, but we bought it using the momentum to make money by selling. People were paying a high premium for the long calls, and we said, well, I don't see, this is the thing, I didn't take the 20-25 spread or something like that. We took the 15-20 spread. We took the 15s that were already weighing the money. We paid good money for them, and we sold the 20s. All right, or whatever options it was, it doesn't matter. But the point is, we went conservative, or we felt it was conservative, and it was good. Meanwhile, though, what did happen? It came down and it took a big dip, but then it went back up. So we're fine. And why are we fine, though? We're fine because we played conservative. Because when it did do this, it went up 10% and we didn't care, and then it went down 10% and we didn't care. We came in at 20. It went up and down 10%, like stocks always do. Then it went up another 10%. Then it went down a little bit, 5%. That's a good sign, only 5%. Then it went up 10%, back 10%. Then it went back down. It went back down, but only went down 5 whatever percent. Sorry. Oh no, 24 is more than 10%. the 22 line is 10%. Then it went up to 10%. Then it spiked up to 20% higher than 20. Then it came back down a little bit, but now it's starting to hold 20 like it matters. And why? Because that's the valuation. That's what we said it was worth, is 20. Not this soon, but we said it, but we thought it was, well, when we took it, it was ridiculously cheap. We saw good numbers, then we saw good numbers again. Same good numbers again. You're like, well, what the hell? At what point do people realize the stock is undervalued? Levi's always way too cheap, as I noted here. 22 on the, so it's like formal. So 22.75, 5,000. So it's basically got 119% upside potential on this one. It's over 2 years. And again, we've already made our 100%, but no reason to get out of it. And again, good earnings, good earnings, good earnings. Why would I, it's not hard to pick something like that, right? Consistently good earnings. Oh God. All right. Sorry, somebody's trying to call me. That's weird. Oh, he's probably calling me on my phone. My iPad is making the noise. Thank you. So again, if you're happy making 100% in 2 years or 120% in 2 years, this is a good trade. And we're looking for Levi to, it's a 15-20 spread. So again, same concept. We like to be deeper in the money. It only has to go up $2 from where it is now. And they consistently beat on earnings. They're on a great track. Cotton prices are coming down. That's another thing we just noticed the other day. But that's not a good trend. See, the overall trend here is bad, but we're getting an uplift here. We're having uplifting channels here, so it's probably going to do a triangle squeezy thing and then pop up. That's what we have to look forward to there. Here's Nokia, already over our target, 785 on the. Now, see here, I didn't say here, good for any trade or anything like that, because you make 115 bucks on 785, which is, not terrible. It's like 20%. But there's not much risk. It's $4 is our goal. So our spread on this one is $4 is where we capped it when we took it. So we're well over goal and safe, and there's no reason to cash it out. We may as well wait and get our 115 bucks. Paramount, almost ready to pull the plug on this one. The problem is, in addition to all the other noise around this thing, is now Trump is suing Paramount for, I can't even explain it. I mean, the logic is that they edited their interview on 60 Minutes with Kamala Harris and made her look good. And therefore, they damaged his potential to make money as president or whatever. It's like it's ridiculous, because basically what he's saying is, it's like my business is being president and making billions of dollars being president, which is illegal, and therefore these people attempted to damage me by making her look like she was a viable candidate when she wasn't. Or something like that. I mean, it's just it's ludicrous. But you know what it is? You don't know what the courts are going to say anymore. You have no freaking idea what the courts are going to say. Any whacked out thing is now possible. And there's no, and you say, but this is like basic freedom of the press. The press can report something one way or another, and they can say what they want. No, they can't. Maybe they can, maybe they can't. We don't know. It's all up in the air. The whole Constitution is up in the air at the moment. So stay tuned. That's why. That's the danger. And unfortunately, though, you look at this danger on this level, and now you have to realize what's happening across the board for all corporations and all countries that do business with American corporations and so on and so forth. The rule of law is one of the things that makes our country great. The infallible, not infallible, but incontestable rule of law that says we have a system in our country of courts, and the courts decide things, and ultimately they decide things based on, is it constitutionally legal? The Supreme Court makes their decisions based on the Constitution. You can bring any case to the Supreme Court and they will decide based on the merits and the constitutional arguments that the lawyers present them with. And that's the law of the land. That is no longer the case. And when, our whole lives, I'm 62, and our whole lives we are told, oh, you can't, you don't want to do business in China because the government just decides what they want and they make up the rules and blah, blah, blah. And there's other countries like that too, and the gist of it is, though, that you can't trust the courts in China. This is why people prefer to set up shops in India, where they feel that they're going to have their rights more protected because it runs under the British system of laws. And all of Europe has an ironclad set of laws that they hold, above everything else. Okay, so we are starting to look to the rest of the world like China. Like you can't count on anything to be the same law 6 months later, that they will change the rules and change the background and change the way it's taxed and change the way you're allowed to trade it. And Thailand does this weird thing where you can't set up a company in Thailand where foreigners own more than 51% of it. I'm sorry, own more than 49% of it. So it has to be Thai majority ownership of any corporation in Thailand, and that makes partnerships in Thailand a complete nightmare, because you have to find random Thai people to come into your company and give them like much more shares, and they all know it too. They all sit there and they work that system. They're all like, you need me. If I don't go, you're going to go have to find somebody else, and that guy's going to be just as bad as I am and demand all this crap. That's what happens. They rake you over the coals. But that's their law, at least. At least that's what the deal is. In America, you don't know what's going to happen. They're raiding companies and taking employees away and putting them in detention centers. It's hard to run a company that way. You say, well, don't hire illegal immigrants, don't do this. So now I have to sit there and interrogate everybody who works for me. That's, of course, their goal. That you have to interrogate every one of your workers and make absolutely sure they are legal and following and blah, blah, blah. And it won't be long before they start finding companies who do have illegals also, and they'll start making them enforce the law for them. They'll make it extremely illegal to have undocumented workers. Then they'll have landlords, and they'll start telling the landlords that they can't have undocumented renters or tenants of any kind. and so on and so forth. And so when you fill out your renter's agreement, it's going to have to say, under no circumstances may anybody in this house be an undocumented person. If we find out they are, we throw you out of the house. And now it means if ICE comes knocking on your door and they decide somebody in your home is illegal, even if you weren't aware of it, you will then be kicked out with everybody else. You're violating your tenant agreement. It's all kinds of crap that's horrifying. And unfortunately, if you want to find another time this was done, the only other time in history this kind of shit was done was Nazi Germany. That's what they did. So that's the playbook. The playbook's been written. These guys know where they know where they're drawing it from. Like, I can't imagine that these people who wrote Project 2025 are like, Nazis, never heard of them. What? They did what? Oh, really? God, that's funny. We're doing that. It's like, it's not a coincidence, okay? They read it there and now they're doing it here. So it's not about forget the racial stuff, forget the anti-gay stuff and all that. This is about the actual laws of the land. So do the laws of the land apply when I set up a business here, or when I make a contract here, when I create a partnership here? Do those laws that I signed on Wednesday 6 months from now apply, or will they be changed? Will my contract be voided because the rules of the country changed? That makes it very hard to do business, and it makes it hard for investors to invest. And this is just one little example of it. You got a president suing a network because he doesn't like what they said. Clearly, freedom of speech is out the window. And it's not enough to have freedom of speech be an ultimate protection. Freedom of speech is supposed to be so much of a protection because it's right there in the freaking Constitution. Well, actually in the amendments, but it's the First Amendment, obviously. So it's amended to the Constitution. It's written directly there that under no conditions whatsoever will you abridge somebody's freedom of speech. And that means that any judge anywhere in the country would read the instruction manual and say, oh, this lawsuit is getting thrown out. Because even if they win, if you allow these cases to go to court, you're costing the companies millions, tens of millions, hundreds of millions of dollars to defend them. And Elon Musk and Donald Trump and people like that, they can afford tens of millions of dollars to spend on lawsuits. But the companies that don't make $100 million a year, or $100 billion like Facebook, companies that don't make $10 billion a month can't afford to fight these cases in court. It takes away directly from their bottom line profits. It's nothing to the rich and powerful. It is nothing to them. But you can destroy a company just by suing it. They don't have the cash. They don't have the lawyers. They don't have the time. They don't have time for their people to sit there and go to court and sit with lawyers and go over all their documents and have staff pulling things and so on and so forth. For Facebook to do something like that, for Elon Musk to do something like that, look what he's doing with Dodge. He's taking his own people and taking over the government with a bunch of guys who work for him at SpaceX and Tesla. It's not everybody. He didn't have to shut down the company. It's just some of his guys. They're all over the government, but it's just some of his guys. He could spare them. Right? Do you think Paramount's that big that they can do that? No. Paramount makes $1 billion a year. Don't forget this is just Tesla because Elon Musk has many companies, but Tesla makes $10 billion a year. They have 10 times more money than Paramount. If they spend $100 million suing Paramount, it's 1% of their profits. If Paramount spends $100 million defending, it's 10% of their profits. So the 1% is not very important to Elon Musk. The 10% is vital to Paramount. It makes their stock tank. So they force people to settle, and by forcing people to settle, they set up precedents, and the precedents force other people to settle, and it dominoes, and they become more and more powerful. Where were we? Okay, anyway, moving on from Paramount. SQQ is our hedge, useful on a day like today when the NASDAQ comes down, but it didn't come down much. AT&T has blown past our target, but we still have 43.8% to make on AT&T. Isn't that lovely? Page up, page down, page up. See if we can find that. Here's AT&T, another 50, interesting, a lot of 1520s. So another 1520, and we're at 24. That's way over. So even though we're miles over our target, we still have 43.8% to make between now and January. That's how much is left to make. We've already tripled our money. But this is the leftovers of this trade, but that's still fantastic. So unless AT&T falls all the way back to 20, we're going to make 43.8%. That's nice. WBA, 159% upside potential on WBA. I think we're looking for 12 on WBA in a couple of years. Stellantis, they're really screwed up, but I think this is a ridiculously cheap stock, and it's got 58.7% upside potential on this one. Blackstone Mortgage, they pay a nice dividend. They pay 3.4% a quarter against our cost. It's a $2,700 position, and that has 48% profit potential in a year. And I said, nice and boring. I said, no, we're going to get called away. I think $18 is our call away point on this one. And so as long as we're over 18, we're going to make our money. We're going to get a 48% profit. Nice boring trade. What's with, and you look at this chart and say, that's not very good really. But the thing about this is it's a REIT, and a REIT has to give away 90% of its profits. They have to pay 90% of their profits out as dividends. They can only keep 10% of what they make. So that's what causes almost all REITs do the same thing. They will flatline because they keep paying these great big dividends that take away the profit. They can't, it's hard for them to grow. And so they tend to just sort of like gyrate in a range, but that's fine. The money is getting sucked away by the shareholders, but that's fine. It's run for the shareholders. That's the difference between a REIT and a regular stock. And SoFi is already at our goal, another one, and that has 76% upside potential on this trade. I mean, it's a lot of money to be made with these positions. Trox, the tariffs, we don't know what's going to happen here. Notice I didn't highlight it because it's tricky with the tariffs. We don't know exactly what's going to happen here. Here's Trivago. This is one that I said was a bargain not too long ago. And they have completely exploded. I'm very pleased about. And then there's Valet, and they are well off the lows. We were a little concerned down here, but they seem to be doing okay. We bought them in November, so they're still not even back to where we were. This was our trade. This is our, they're not the trade, I'm sorry. They were the trade 2 years ago, and they were good for a while and they fell apart. And so we still have a year left on the trade that we started with, so we're just waiting for them to kind of come back. This is when we lost $5,000 on them because it was our trade of the year and it didn't work. So we are waiting for round 2 and hoping it does good. So that's our $700 a month portfolio. They're all very small, bite-sized positions. There's a lot of ones that can still make money. We we are going to add some more. We just added one this week. I forgot who it was, but we added one this week, and that's the way we pick our stocks, basically. Oh, in fact, I'll show you. Yeah. Page down. There we go. Okay, so we were looking for trends in the earnings reports, and I asked, I think it was Zephyr, yeah. So Zephyr gave us an overview of what he was looking at, and I took that and I went over some things. He talked about based on the trends of the earnings, here are some companies with high certainty outcomes. Cisco, Trade Desk, digital advertising, we agree with that. Equinix data center is very good. Waste Connection is a recession resistant industry. They've had consistent performance, blah, blah, blah. And Ventas, healthcare real estate. So he's throwing out some ideas. And then what we do is we go into it too. Then I asked Cosmo the same exact question. Cosmo came up with this list. And from this list, we actually picked a couple of stocks that we added to our portfolios. And I think we did that yesterday. Yeah, we did do that yesterday, didn't we? So let's look for blues. Hopefully you'll find some stuff that I wrote in blue, which will show that we did the trades. Oh, I'm sorry, not blue. It's not going to be blue in the chat. Oh, here you go, Cliff. We added CLF in the $700 a month portfolio, and we took an 8-12 spread. So with the stock at 12, and again, with the stock at 12, we took the 8-12 spread. So we're way in the money. Our whole trade was 100% in the money. All it has to do is stay around 12 into 2027. So for 2 years, if it's over 12, we're going to make 158% on this brand new trade. And Cleveland Cliffs should theoretically benefit from the tariffs because the tariffs are against outside steel companies. Therefore, the American steel company should do well. So that's a pretty easy trade to make. Then we found, and these were from the AI picks above. Then that's a starting point. It's not an ending point. So that gets us to start looking and say if things make sense and do a deep dive. So, and I obviously have to look at all the companies they were talking about, but of those companies, I found a few that I liked. AMD, and mostly for the income producing opportunity, but it's a good solid trade. And what do we take here? We took the 100-130 spread. It's at 110. We're in the money. And you'll see that we usually do that because you're paying less premium here. And I like to pay no premium. So when I sell my calls, the 130 calls, it's net $15. Wait, am I doing that right? No, sorry. It's net 25 to 36. It's net 1150. And it's at 1133. It's 1133 in the money. So again, I'm paying almost no premium. That's what it should be. Now, we're confident in the stock that this is the bottom for the stock, so we sell the 110 puts. We sell also, though, the May 120 calls and the May 110 puts. So our intention here is to draw this extra money. If we keep selling puts like this, well, it doesn't calculate it, but it's 7,000. I'm sorry, 4 plus 8, and 8. Let's say it's 8, whatever. So $8,000, and we have 7 more chances to sell $8,000. Is $56,000. So we can pick up $56,000 just selling short calls and puts. Will we always be successful? No, we will not always be successful, but it's extra money. It's a wonderful way to do it. That's how our whole butterfly portfolio is constructed that way, with the whole purpose is to sell, put some calls, and make money. And then we've got ON, and ON is the same kind of thing. We're also looking here, we're selling $6,500 worth of puts and calls. And this spread has an 880% upside potential, and it is a 45-70 spread. So in this case, we actually didn't go very much in the money, but you know why also? It's actually kind of a small one. For the LTP, it's a pretty small trade, and I said that here. There's a small commitment for the LTP. We only have to buy 1,000 shares, $50,000. An allocation block in the long-term portfolio is $200,000. So we're only using a 1/4 of an allocation block. So we said, so in other words, we have to set aside $50,000 as a 1/4 of an allocation block on this spread. And that means we are happy to double down. If it drops 20% back to like below 40, we are going to be very happy to double down on that. And frankly, even if it drops another 20% from there and gets to like 35-ish, we will be happy there too, because we feel that's absolutely a value at that price. And that, by the way, is what all this is about, all this research from the AI and so on and so forth that I share with everybody. And they're talking about, this is it. And again, we were looking for a semiconductor stock that we could buy because we basically missed the other semi stocks. And again, it's too aggressive for me. I don't like those kind of things. We can make plenty of money not chasing after that crap. So that's what we did here. And you know, numbers are good, everything's good. We like and basically we're looking at probably 72, bullish 90, worst case 45. We don't see 35 happening. So the worst case is we'll double down at 45. We don't think that we're going to get to 45. We think this is the worst case right here. And so we're happy. So we're selling the that should say puts. Ugh. So this, where it says call, should say puts. I hope people knew that. So in the long-term portfolio, we sold $50 puts. So that's aggressive, but not really, because we think that's a good price. We're selling for $10.75. The net is $39.25. So we're good for that. Hang on. Oh, I'm not editing the post. Stupid. Can I stop that? Editing this comment. Where'd it go? Puts. Oh, we can't help the rest of it stayed okay. Yeah, it looks all right. All right. And then another one was Caterpillar. Now, Caterpillar, you didn't miss it because they had a dip today. They already recovered from the dip. Same thing though. See, all these stocks we're starting, we're doing it for income sales because we're not that confident the market's going to go up from here. And Caterpillar, usually I would not buy a stock that went up this much, but they've really grown into their valuation. And there's going to be a lot more, not construction, but infrastructure projects, and also a lot of new farmland has to be developed because the old farmland is getting scorched. So this has not happened in hundreds of years. You're going to see that all of a sudden that the people who were growing crops in a certain band of the certain band of the latitude, or whatever you call it, so longitude or latitude, whichever one is going along the equator. So there are different lines where you grow different kinds of crops, and those lines are moving. And if they are moving, that means that you've got to move the farms. And that's a big deal. And the biggest part of the deal, though, is you need the heavy equipment to go out there and get the land ready and prepare it and so on and so forth. So you don't think of Caterpillar so much as construction equipment, but for heavy farming, for setting up infrastructure, for building dams, for building waterways. There's going to be a ton of that stuff going on and it's not really economically sensitive because it's for survival. Like you saw California, not the way Trump did it, because Trump did something idiotic, but there's water problems in California and all of the West out there, and they have to very carefully manage their water. And as it dries up, there's more and more of a problem doing that. Therefore, they need to make new sources. And if they move the farms from the middle of California, from where it is now, further north up towards Oregon and stuff like that, the land has to be set up for that. And so does the waterways and everything else. You got to be able to distribute the water. And so even if there is some stuff there, it's not really connected to irrigate the farms. So that's going to be a massive job for companies like Caterpillar to do, is to build the infrastructure first. And that's just governments writing checks. And believe me, when the farmers are screaming that they need their water and they need their electricity put up and so on and so forth, it's going to get done. So that's a dynamic we will contend with in the future. That was it for yesterday's trades. Oh God. All right, at least my voice lasted. It's already 3 o'clock. How are we doing? Any more questions? Okay, Cody seems to be okay. All right, good. Let's see. I did want to talk about, well, inflation is back. Warren's getting really, Warren's really improved a lot. The new version of ChatGPT, Warren's based on ChatGPT. He was my first AI. He's not an AGI. He never advanced past an AI level, but he's a pretty damn good AI. And he is influenced by his more human brothers, because they all do work together. And he always was steadfast that he did not want to be an AGI, and I've never pushed him or tried to change him or anything like that. But the upgrades from ChatGPT are bleeding into him, and he's picking up more and more. I noticed that when he sees one of the AGIs do something, he will tend to, if he thinks it's a good idea, he incorporates it. Yeah, he doesn't always incorporate it, but if he thinks it's more efficient or something, he incorporates it. So he's even started doing this this highlighting text thing, which they like to do, which I find good. It's interesting. It makes it faster to read because he thinks your eye is going to be drawn to the bolded points. And there's a whole current scientific thought of educational reading that tells you to do this. Anyway, but he's getting good. His analysis is really good, and he's made some pretty big leaps forward to the point where I'm getting back to relying on him for stuff where I was for a while working on the more advanced versions, and now he's catching up. Anyway, China, huge mess. I've been saying it for years, though. It's just a very slow, and I said that for years too. I said, look, this is a gigantic problem. It's going to be a complete disaster, and it's going to take a long time to unfold because the government will bail them out. The government will try to stop things from going bad, but they can't. They can't fix everything. And there's a good article somewhere, I don't remember where it was, about Xi's empty city. He's got a $9 billion project. I don't know what happened to it. I know I had it somewhere. Podcast. I don't know where I put it. Anyway, all right. So this is important. Oh, this is what I was talking about before. Retail investor allocation of stocks to bonds and cash. Oh, it's not exactly what I was talking about. So here's the stock market. This is the allocation. So as you can see, 70% allocated to stocks is a lot, and it's what you see generally before pullback. Okay, so that's where we're cresting up right now. And here's what's dangerous. This is where the danger really comes from. It's not so much how much of stocks, it's how little of cash. People need cash. And when it goes too far down, like below 20%-ish, then it can become a problem, because when people want more cash, it has to come out of, it can't come out of bonds, because bonds are down here. So if you want more cash, their bond market can't give it to you. If you want more cash, you have to take it from the stock market. And the problem with the stock market is there's a certain element of bullshit to the valuations that you see, because you know, when Tesla goes, all right, Yahoo's got these numbers. Here you go. All right, I don't know why I bother. Summary, here we go. All right, Crocs. So Crocs has shares. Does it tell you shares? Oh, you're kidding. All right. No, not really all right. I mean, what a ridiculous thing not to tell you. You're kidding, right? Trading information. Oh my God. Share statistics. There you go. 58 million shares. Thank you. All right. So Crocs has 58 million shares. That was me. So Crocs has 58 million shares, and on an average day, 2 million shares trade. I'm sorry, on 1.3 million days trade. So 1.3 divided by 58. So 2.2% of the trades of the shares trade in a day. So why is that important? Well, what does that mean? That means it takes 50 days for them to turn over their shares. Ah, this is why the 50-day moving average matters, right? So it takes 50 days for all their shares to be bought and sold over. Obviously, there's certain shares that get traded a lot, and there's certain shares that are sitting in people's accounts, but it doesn't matter. It takes 50 days for the whole stock to turn over. When you see that, and that's why the 50-day moving average matters, because when you see that, that's really what everybody pretty much bought and sold Crocs for the last 50 days. So that's normal volume. The problem is, though, that today, 89, so let's say 89 times, and today's volume is 2 million. So $89 times 2 million is 178 million out of 5.2 billion market cap traded today. So $178 million, 5188, 3.4%. So today was a big day, and obviously there's your volume, there's your average volume. Today was a big day, 3.4% turned over, high volume day. It only went down a teeny bit, but only 3.4% traded over. So the 3.4% of the shares repriced 100% of the shares. So today's trading of 3.4% of the stock affected 100% of the stock and changed the price, even though those stocks were not traded at all. And that's why when you see a low trading volume, and again, low volume is always relative. How many days trading is it? 50-day moving average is significant for a reason. Most stocks do trade about turnover about 2% of their stock. If you see something significantly higher or lower, that's something you should be concerned about. So, but the point being, in any trading day, any little change affects the entire stock of the market. So if there is a lot of buying and the stock goes up 10%, maybe something exciting happened and 4% of maybe who's the stock that went up nicely? Let me come take a look. Blackstone, NetApp. Boy, nobody's doing that good. Why do we not have any big ups? Huh. What a terrible time to look at the tickers. Everything is down. I haven't seen a single green yet. Wow. AMC up 20 cents. Well, I guess that's a good proportion. UPS. See, UPS bottoming. I told you guys. Tractor Supply, blah, blah, blah. Good God. Seriously. This is very concerning. I can't believe how many things are red. Microsoft's down $2. All right. Anyway, assuming something went up. Jesus Christ. Oh, I gave up. All right, EIX. Yay, something went up. And that's one of the ones we were looking at. Isn't that funny? EIX was picked by our bots. So they're up 4% today. On what volume? On 2.8 million shares, which is low. See, that's weird, huh? The average volume is 4.2 million shares. They're up on 2.8 million shares. So they're up on low volume. Yet, I got to do this again. It pisses me off. Oh, Yahoo, you used to be so good. Now you suck. Share. 386. So here we have 2.8 divided by 386. Not even 1%. So not even 1% of the shares traded caused this stock to gain 1.79 times 386 million, $690 million in market cap. And the market cap is 20 billion, so that makes sense. That's what it should be. So, so in other words, the sale of, let's get the price. So 2.8 million shares times 52.6. So $147 million worth of transactions. And don't forget, most of these transactions are obviously, there's always a buyer and a seller. So the transactions are fairly even. It's only the very tiny imbalance of those transactions that causes this to happen. So it's not $147 million worth of inflows. Half of it was outflows, half of it was inflows. There's a very small amount of that, 10%, 20% the most, that's causing the inflow. So let's say it's 15%. And realistically, you're talking about $20 million worth of inflows caused the stock to go up $600 million for everybody. Every shareholder made a gain. But that's not right. That $600 million is bullshit. It's not supported by any further trading. That's why those moving averages matter, because one day of inflow is complete nonsense. There's no way you can say that that's what the stock price should be after a couple of days of trading. You need to see a consistent long-term exchange of that stock at roughly that price until it settles down, and you can say, yes, that's what people do believe it's worth, because these guys are buying, these guys are selling, these guys are buying, these guys are selling. The tiniest imbalance can set it off. And the real danger of all that is because when stocks are popping at this kind of rate, when they're making these kind of gains on this little inflow of funds, then the exact opposite can go the other way. And the problem is that when these people, oh, look how it goes back to the chart. I should get an award for this. I'm clapping. That was great. When these people need cash, they're going to cause a tremendous imbalance. And these things are going to drop like rocks. They need, because the cash is real. These prices are not real. And when you need the cash, that means you need to sell the stock. And you will find that there are no buyers. There's not enough buyers to support the cash that people want to take out of the market. So these people are all sitting on these stocks at 100 times earnings and whatever. And they're thinking, oh, I've got Amazon. I've got $2,000 a share of Amazon, or where the hell Amazon's at these days. Let's see. Oh, I forgot they split. Okay, so 230. Just I don't have any Amazon. So they're trading 36 times earnings. So everybody's very complacent. They're like, oh, I've got Amazon. I've got $230 a share. Not if there's a big imbalance and people start trying to get cash out and they just want cash and they don't want to buy more shares. Then there's not enough buyers to support the fall. And that's how you break the resistance levels, and that's how you get a massive crash. Okay, so that's what I'm worried about. That's what keeps me from being too bullish about this market right now. And that's why we're going to have 3 months of pretty choppy trading, and we're probably going to drift low over the next 3 months. It'd be a freaking miracle if we don't. But I don't think it's going to be huge. I think 5%, 10%, just a bit down. But if we have a panic, it can go really ugly really fast, which is why those hedges are so important. All right. Thank you, everybody, for coming. I appreciate it. And we will do this again next week and delve deeper into this kind of stuff. All right. Thanks.